The markets are rattled. Trump's tariffs are escalating. And hedge fund legend Bill Ackman is warning of an economic nuclear winter. Is Wall Street sleepwalking into disaster, or is this just market noise? Let's unpack the real risks. Hey everyone, I'm Robert, and this is The Alternative Investor. Today we're diving deep into a topic that's heating up fast, whether the stock market could be on the edge of a catastrophic downturn. With aggressive new tariffs, rising geopolitical friction, and increasing signs of economic stress, some experts are starting to sound the alarm. So in this video, we're going to break down the current risks, examine key data points, and talk about how you can position your portfolio to stay protected, no matter how cold this nuclear winter might get. On April 2, 2025, President Trump officially declared Liberation Day and introduced a broad new tariff policy. This included a 10% blanket tariff on most imports and much steeper tariffs on key trade partners. China faced tariffs as high as 125%, while countries like Mexico and EU nations were also hit hard. Trump's rationale was to bring back American manufacturing and reduce trade dependence, but markets reacted violently. Within 48 hours, the Dow Jones Industrial Average plunged more than 4,000 points, wiping out months of gains. The S&P 500 fell nearly 14% from its February highs, marking one of the fastest and sharpest corrections in modern market history. Industries most affected were those with global supply chains, including the automotive sector, semiconductor manufacturing, and retail giants that rely heavily on imports. These companies saw their costs spike, profits slashed, and stock prices punished. This wasn't just a short-term reaction. It was a full-scale revaluation of economic expectations based on policy risk. Investor Bill Ackman, known for his market foresight in the COVID crash of 2020, came out with one of the most dramatic warnings yet. He called on the Trump administration to issue a 90-day timeout on tariffs to prevent what he described as a self-inflicted economic nuclear winter. Ackman's concern is rooted in multiple layers of fallout. First, business investment is already drying up, as uncertainty around costs, supply chains, and future demand makes companies hesitant to spend. Second, consumer confidence is beginning to decline, with people cutting back on major purchases amid fears of inflation and job cuts. He also pointed out that as tariffs increase prices, inflation will likely rise again, right after the Federal Reserve spent nearly 2 years trying to cool it. And perhaps most dangerously, global retaliation could lead to U.S. companies being locked out of foreign markets, crushing exports. Ackman's comments are being echoed by multiple fund managers and economists, many of whom are warning that if the current trajectory continues, we may not just see a recession, we could experience a multi-year stagnation. If you want to know how nervous investors are, just look at the CBOE Volatility Index, also known as the fear gauge. In recent weeks, the VIX has surged to levels not seen since the banking sector scare of early 2023, signaling extreme concern about near-term market conditions. We're also seeing signs of stress in the bond market. Liquidity in U.S. Treasuries is thinning, making it harder for large institutions to move money quickly without affecting prices. This is a key warning sign because when the Treasury market tightens, credit markets tend to follow. At the same time, high-yield or junk bonds are selling off, with yields rising above 9%. That means lenders are demanding higher returns to take on risk, which typically happens when a recession is looming. The US dollar index has also fallen 3% in just 2 weeks, suggesting that global investors are reducing exposure to US assets. Some are rotating into safe havens like gold, the Japanese yen, and even Bitcoin, a sign that confidence is eroding. Together, these are not just technical blips. They're signals that liquidity is drying up, and investors are starting to price in potential disaster. Tariffs aren't just a stock market story, they directly impact the real economy. Let's start with consumers. With new tariffs on imported electronics, vehicles, appliances, and clothing, everyday Americans are about to pay more for basic goods. These added costs trickle down fast, especially for working-class households who are already stretched thin. Inflation, which had finally begun cooling down in late 2024, is now expected to re-accelerate into the summer of 2025, just as the Fed hoped to start lowering rates. On the labor side, companies are reacting cautiously. Faced with higher costs and declining profits, many are slowing hiring, implementing spending freezes, or even preparing for layoffs. Sectors like logistics, manufacturing, and retail are especially vulnerable. The World Bank and IMF have both downgraded their forecasts for U.S. GDP growth. If current policies stay in place, U.S. growth could drop below 1% in 2025, while global trade volumes are already shrinking, especially in Asia and Europe. This is how an economic contraction begins, not with a crash, but with a slow, grinding stall in confidence, spending, and hiring. Right now, every major recession signal is flashing. The yield curve is inverted again, meaning 2-year Treasury bonds yield more than 10-year bonds, a classic red flag for economic downturns. Earnings guidance from Fortune 500 companies is being revised downward, and corporate insiders are beginning to sell stock at an accelerating pace, often a sign that turbulence lies ahead. Meanwhile, consumer debt has reached record levels, with credit card balances and delinquency rates spiking. At the same time, the U.S. savings rate is at a 17-year low, giving households less room to absorb shocks. Add to that a fragile geopolitical environment, rising tension with China, oil volatility from the Middle East, and a struggling European economy, and it's easy to see how a local tariff issue could turn into a global slowdown. This doesn't mean a 2008-style collapse is guaranteed, but it does suggest we could be entering a 1970s-style stagflation scenario, high inflation, stagnant growth, and years of weak market returns. So how do you protect your portfolio, or even grow it, in this climate? First, it's essential to diversify beyond U.S. large caps. That includes allocating to international stocks, value-oriented sectors, real estate investment trusts, REITs, and possibly even commodities like energy or metals. Second, consider adding defensive stocks to your portfolio. Companies in sectors like utilities, consumer staples, and healthcare tend to be more resilient in downturns because demand stays stable, even when the economy slows. Third, if you're holding long positions and don't want to sell, raising some cash on the side can be a smart way to prepare for opportunities. When volatility spikes, having dry powder gives you the ability to buy when others are forced to sell. Fourth, explore alternative investments. That includes short-duration bonds, dividend stocks, and even covered call or cash-secured put strategies to generate income while reducing volatility. And finally, the most important tool you have is discipline. Don't panic. Don't follow headlines. Stick to a well-reasoned plan based on long-term fundamentals. So, could we be heading into a nuclear winter for the markets? The warning signs are stacking up. Tariffs, inflation, declining consumer confidence, and slowing global growth are all converging. And if this continues unchecked, it could freeze the market for months or even years. That said, these are also the moments when smart investors build wealth, not by gambling, but by planning and positioning. If this video helped you see the landscape more clearly, hit that like button, subscribe to The Alternative Investor, and share your strategy in the comments. Are you playing defense or gearing up for opportunity? I'm Robert, and I'll see you in the next one.